Hello friends, last week in my video, we discussed how a few percentage points decline could be expected as a routine matter because the markets were at a new high. What should be our game plan going forward? What's so special about December? This video is all about discussing all that and more. On your screen right now is the market roundup window, which tells us that the broad-based Nifty 50 fell. It was the banking stocks led by the Bank Nifty that rose. The US dollar index, the Dixie, rose, and that is one of the reasons why our markets felt the heat. Bullion rose in spite of a firm dollar. That tells you there was a shift to safer havens, and crude oil fell along with natural gas. This is something that I told you. Natural gas recent rally was more cyclical and weather related rather than anything else. And oil, as I have been putting up on my Telegram channel, is not in a super cycle. The USD INR, which is the dollar versus the rupee, rose, and that also impacted sentiments adversely in our market. The NSE lost a little under 1% in market capitalization. MWPL went up, which is routine. And more importantly, the US market provided headwinds and weak kind of triggers for our local market. Let's take a look at the Dow Jones Industrial Average daily chart. What you are seeing is a 3-day out of 5 session decline last week, and the red candles are fairly prominent. The last mile 34,281 level, which I said we must stay above, has been breached downwards. The golden cross, which is the 50-day moving average crossing the 200-day moving average upwards, still remains in place, and the probability of the 33,000 to 32,500 level being an area of support needs watching. The Nasdaq 100, the index that directly has bearing on our technology stocks, also is below its 11,682 level, which we wanted it to stay above. The death cross here has not been negated at all, and what we are seeing is a 4-day decline out of 5 sessions last week. So pressure for tech stocks. Now, S&P 500, the broadest base index of them all, still in a death cross because the 50-day average remains below the 200-day average. The 3,900 level, which is a sort of make or break level for this index, remains to be watched in the coming few trading sessions. Do remember that 14th and 15th are very critical in terms of the Federal Reserve, the Bank of England, etc., meeting for setting the interest rates going forward, and of course the forward guidance emanating thereof. Coming back to our domestic markets, what we are seeing is MWPL, or market-wide position limits, rise rapidly to 30.83. Will we go past the November's series high at 32.93? Time will tell, but do remember, this is possibly the last full week where trader participation is going to be high. Thereafter, holiday season kicks in and markets will see thinner volumes. The stock and index futures turnover combined for 3 derivative cycles, that is December, January and February, have seen a very mild uptick, but they remain at the lower end of the 20-week period, which is because of the holiday season and lack of trader participation at higher levels. Where the NSE advanced decline ratio is concerned, what we are seeing is the Nifty falling 1.07% over the previous week, but the NSE advanced decline ratio convincingly below the 1 level. Now, this tells you that Marshmallow traders lack the buying conviction at lower levels to offer any kind of proactive support. This ratio needs watching. I update this on my social media accounts every day. Now, the prompt month basis of the Nifty and the Bank Nifty. This is the premium of discount of the futures over spot, and it tells you the risk appetite in the market. Both the indices saw a sharp decline in basis. This was in line with what I advocated a fortnight ago, that these kind of lofty premiums on the futures were unlikely to hold. And much of the decline in the indices on a week on week basis has also occurred because the premium has eroded. It's not as much as a fall alone, but the shrinkage of premium. But as long as the basis is positive, which means the futures quote at a premium to cash, bulls still have some hope. They have not yet surrendered hope. Now for our in-house indicator, the impetus which you've trusted for over 18 months now, and that is basically telling me that both the Nifty and the Bank Nifty impetus has fallen to a period low. This is a 20-week low. One of the reasons is December generally tends to be a thin volume and low participation month. But nevertheless, this is one small worry for the markets that needs watching. Coming up on your screen is the LWTD indicator, which has again turned below zero after staying above the zero mark for 2 consecutive weeks. The Nifty itself has seen the percentage gain loss line. The blue one has seen a decline here. And since the LWTD and the Nifty percentage gain loss line both have fallen in tandem, it means there is a possibility of some selling at higher levels in the week ahead. Now for the footprint of the 4 market participants, starting with the FIIs. FIIs have reduced their long positions across indices and stock futures. So they are basically taking a measured approach. Where DIIs are concerned, they've reduced their index short positions, but they've increased their stock short positions. Then they usually always net short because they are buying in cash and hedging those purchases in the cash segment by shorting in the derivative series. Now for prop traders, these guys have gone gung-ho. They've increased their net long positions in individual stocks, but they've stepped up their net short positions in index futures, which is a kind of a hedge. So they are basically trying to mitigate risk. Where retail guys are concerned, these guys have done all the heavy lifting since the COVID-based lockdowns were imposed over 2.5 years ago. They've now taken their net long positions in individual stocks to a multi-month high. They are at 1.2 million lots in individual stocks. They've also increased their net long positions in index futures, which tells you that they're buying across the board more or less. Will these guys be able to push the market up, which they have been doing for almost 2 years with a little help from prop and institutions? Will these guys be able to push it alone? The coming week should tell. Friends, I now come to the 4 index heavyweights, starting with the biggest boy of them all, Reliance Industries. In the month of November, the weightage has gone up to 11.36 from 11.03 in October. Beta has gone down marginally. The impact cost remains unchanged, but the stock has fallen on 4 out of 5 trading sessions last week, violated the 2,677 level, which I said we need to stay above, and also closed below the 25-day exponential moving average. Now, this is the heaviest weighted stock, and the fact that it has fallen below its moving average is a mild red flag. HDFC Bank, the second most heavily weighted stock in the Nifty, with the weightage gone up to 8.53 compared to October's 8.26. Bank Nifty weightage also has gone up to 26.30 from 25.61. The beta has also stepped up to 1.1. So my intraday trader friends need to be a little more cautious because volatility on HDFC Bank has risen a tad. Impact cost remains unchanged. Price is comfortably above its 25-day exponential moving average, which itself is rising. So no negative surprises are likely. And once you start trading above the 1,650, HDFC Bank can provide a lot of boost to the Nifty and the Bank Nifty. Now for the third weighted stock, Infosys, whose weightage has also gone up on a month-on-month basis, and beta has risen as well. Note the huge red candle on Friday. Remember, the Nasdaq has closed down on a week-on-week basis. I told you the Indian IT stocks get influenced, and there you go. Stock is below the 25-day exponential moving average. So the outlook from Infi is somewhat cautious. It's unlikely to provide too much of support to the Nifty. Fourth in the list, the last one, ICICI Bank weightage has gone up to 8% in the Nifty and 24.67 in the Bank Nifty. Beta remains constant, but the price is meandering around its 25-day exponential moving average, which is more or less rising. It's showing some signs of pausing for breath, if not slight fatigue. Ideally, I would want ICICI Bank to trade consistently above the 960-965 mark so as to provide proactive support to Nifty and Bank Nifty. Early days yet, we'll keep watching. Now, friends, for the bond markets, which are very close to my heart, especially for Bank Nifty traders and banking stock traders, bond yields have gone up, which means bond prices have reduced. That is providing a mark-to-market pressure for banks, which are normally the biggest investors in the bond markets. I have been constantly telling you to keep laddering your sovereign investments, not just bonds. I continue to ladder myself, and I would advise you to continue doing so. Would you deploy at the present levels? Not necessarily, because I would ideally want the yields to cross 7.50 before writing out the next check. As soon as the time is ripe for deploying fresh funds in the fixed income market, remain assured you will get an update on our free Telegram channel. The hyperlink to joining a free channel on Telegram is in the description and in the pinned comment below. Friends, coming now to the US dollar index, which basically has been causing a lot of turbulence in the global financial markets. What you are seeing on the daily chart on your screen is that this index fell on 2 out of 5 trading sessions last week. But the falls were kind of insignificant compared to the rallies. The 104.51 support that I advocated in my video last week has more or less been able to stop the decline from here onwards. Price is below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook is under pressure. The weekly chart on your screen tells us that the price is below its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook is also somewhat under slight pressure. But the 104.5 level needs watching. Last week, I advocated a range between 107.02 on the upside and 102.02 on the downside, which held perfectly well. In the coming week, I expect a range between 107.37 on the upside and 102.49 on the downside. Do remember, this is a very critical week ahead because on the 14th and 15th, there are going to be major announcement in terms of US Federal Reserve and the Bank of England on their coupon rates, and therefore could provide some turbulence in the market ahead. Friends, the US dollar index done. I now come to the Bank Nifty, which gained 1.23% last week. It rose on 3 out of 5 trading sessions. As you can see on the daily chart on your screen, the Thursday was a power candle day. The biggest rally of last week came on Thursday. So the bulls must defend Thursday's low in case of declines on an intraday basis in the coming few trading sessions for the week ahead. Price is above its 25-day exponential moving average. That's a month-long holding on cost of an average bull. The average itself is rising, so the short-term outlook remains positive. The weekly chart on your screen shows us that the price is staying above the 41,840 levels, which is the previous swing high. That's going to be a support in case of declines. As long as the Bank Nifty, falls but stays above 41,840, I think the bulls are still in the driver's seat, although the bullish candles in the last 6 weeks have been smaller and smaller in ranges. I want a power candle on the bullish side so that the sentiments could improve dramatically. In the week before last, this index was number 5 on our most volatile list in our statistical beta list that we maintain in-house. It's slipped 4 notches to number 9. That's good because volatility comes down. That's easier for an average retail trader to manage. Last week, I advocated a range between 44,450 on the upside and 41,750 on the downside, which held. In the coming week, I expect a range between 44,950 on the upside and 42,300 on the downside. Friends, I continuously remind my viewers and my online family through my videos and through my articles on Live Mint that trading should be light in the month of December because your bid and offer spreads are likely to get wider. That's a challenge that takes away some of your take-home profits. So let's be careful out there. The Bank Nifty done. I now move to the Nifty 50, which lost 1.07%. As you can see on the daily chart on your screen, it fell on 3 out of 5 trading sessions. Friday's power candle, the bearish red candle, is something that needs to be watched. The high of this candle, which is at 18,665, needs to be overcome on a sustained closing basis if the bulls are going to grab back control from the bears. Now, staying above the 18,400 mark serves 2 purposes. Number 1, it's somewhat of a previous swing high support, and it is also coinciding with the 25-day exponential moving average. So in case of declines, if the bulls are managing to stop the fall and limit it to 18,350, 18,400, all is well. But any sustained decline below that and you have a slight issue. The weekly chart on your screen tells you that the week's bearish candle is actually a bearish piercing candle. It has pierced the body of the previous bullish candle by 50% or more, and that tells you that some consolidation may be on the cards. Last week I warned you that the price is significantly above its 25-week exponential moving average, which means mean reversion could occur. Either the price falls towards the moving average or the price consolidates with the moving average playing catch up, which is why in December, especially at around a new high, if there is a few percentage points decline, I would not take it as anything out of the ordinary. It's only when a previous swing low or any such bearish event occurs, then I would start worrying. Do remember, as per the classic Dow theory, a decline of less than 10% is just a routine correction. It's only after a 20% fall from the peak should you say that a bear market has started. So let's not jump the gun. Of course, you shouldn't be buying in bucket loads and get too greedy. But at the same time, let's not write off the bulls as yet. Now, in the week before last, this index was at number 9 in our in-house statistical beta list of most volatile counters. It fell full 7 notches to appear at number 16, which tells you that there is a D-trend. Do remember, the impetus on the Nifty and the Bank Nifty has come down very, very sharply. Momentum and force from traders has reduced. Also note that the media news of 75% decline in inflows into equity mutual funds in the month of November, which has taken the inflows to 21-month lows, is also telling you that there is caution in the undertone where fresh inflows into mutual funds are concerned at new highs, number 1. Number 2, December is historically, and I've pointed this out many times, historically a month where FIIs tend to go away for their annual leave towards the fag end of this month. Volumes contract, interest in the market remains alive, but participation levels fall. So volatility may just go up. Let's be careful out there. Now, last week I advocated a range between 19,200 on the upside and 18,200 on the downside, which held perfectly well. In the coming week, I expect a range between 18,975 on the upside and 18,025 on the downside. And trade light, like I told you, and avoid those individual counters where the bid and offer spreads, the difference between the buyer and the seller's limit is more than 6 tick prices. Anything more than that, just avoid the counter. Now, I come to the last bit of charting, which will measure the risk appetite of the retail segment by way of their footprint in the individual stocks vis-a-vis the index derivatives. On your screen now is the chart of the percentage turnover provided by each segment. The sky blue line, which is the stock options turnover, is at a multi-week high, where it tells you that risk appetite in individual stock options has gone up. And the olive green line is the stock futures turnover component, which has also gone to the high point of the prior week. So risk appetite remains. Now, the next chart on our screen tells us the the index options turnover. Do remember, this segment provides more than 90% of the entire turnover in the derivative segment. The turnover typically falls on Friday because Thursday is the weekly expiry, and the last Friday's turnover has fallen less than the Friday prior. So more of the turnover from options is coming from index, and that tells you that compared to the previous week, risk appetite is slightly reduced. No great surprises there. Do remember, holiday season, FII is going off for a break, so this needs watching. Although I would have wanted more turnover coming in from index futures, but like I said, institutional activity goes down a bit. Now, friends, for the most popular segment of this video for statistical traders, I give you 5 stocks which gain the most amount of impetus on Friday. So you take small exposure, wait for large price moves on Monday, and 5 stocks that lost the most amount of impetus. So you take big lots and wait for small price moves. This is for scalpers. Do remember, this list is valid only for Monday. If you want to be updated with this list Tuesday to Friday, please subscribe to our free Telegram channel. Now, the list of impetus gainers is led by Siemens, followed by Bank of Baroda, Kotak Bank, Crompton, and Indus Tower. The list of impetus losers is led by Apollo Tyres, followed by Indian Oil Corporation, RBL Bank, Indraprastha Gas, and Balakrishna Industries. Before I draw this video to a close, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. Also, do let me know how my videos are helping you get better in your trade craft. Thank you for your patience and being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.